Do not adjust your screen. What you are seeing is not a glitch, not a bad data feed, not a delayed refresh. Silver didn't rise today. It teleported. We are witnessing a market that moved $6 in a single session. Silver is trading at $78.83, up 8.25% in one day. That does not happen in a healthy, liquid market. That does not happen on a quiet Tuesday morning. That happens when something breaks. If you were waiting for confirmation, this is it. This is not momentum. This is not speculation. This is a liquidity vacuum. For weeks, we warned you that the Western price was wrong. That New York was trading silver at a discount to the rest of the world. That the paper price was being held down while the physical market quietly disappeared. Today, the elastic snapped. The United States price is now chasing the global price, not leading it. And even after today's vertical move, it is still behind. Fresh data from the Shanghai Gold Exchange shows silver trading at $83.98. That's a $5 gap that still hasn't closed. That gap is not noise. It is a magnet. In this emergency market breakdown, we're going to dissect exactly why silver exploded higher. We're going to show you how arbitrage algorithms are buying everything they can in New York to close the gap with China. We're going to explain how last week, as short sellers are being liquidated in real time. And we're going to show you why $78 may be the cheapest silver you will see for the rest of the year. This was the day the dam broke. To understand today's move, you need to understand the physics of a vacuum. In a normal market, sellers exist at every price. Someone sells at 73. Someone sells at 74. Someone sells at 75. The price grinds higher as buyers chew through that supply. Today, there were no sellers. The ask side of the order book was empty. The banks that normally sell futures to cap the price stepped aside. Why? Because selling silver at $75 in New York while it trades near $84 in China is handing out free money. Anyone with access to physical delivery could arbitrage that spread instantly. So the banks pulled their offers. Then the buyers arrived. Pension funds, industrial hedgers, institutions, and they found an empty room. Market buys slammed into nothing. Price skipped from 73 to 75 to 78 without resistance. That is not a rally. That is teleportation. It confirms what many refuse to believe. The tradable float is gone. The buffer inventory that once absorbed demand has vanished. And when there is no buffer, price becomes the shock absorber. This volatility is not a malfunction. It is the signature of a shortage. And the candle you just saw, the $6 candle, is the sound of the paper market snapping under the weight of physical reality. Now let's talk about the force driving this move, because it isn't emotion. It isn't hype. It isn't retail traders chasing candles. It is arbitrage, the most ruthless, mechanical, and relentless force in all of finance. Right now, silver in New York is trading at $78.83. Silver in China is trading at $83.98. That $5 spread should not exist. Markets can tolerate small inefficiencies for minutes or hours. They cannot tolerate structural price gaps between two major exchanges for the same asset. It violates the law of one price. And when that law is broken, the algorithms wake up. Arbitrage traders don't care about narratives. They don't care about RSI. They don't care if the chart looks extended. They care about one thing: cheap silver versus expensive silver. As long as New York trades below Shanghai, buying pressure in the West is mathematically guaranteed. Bots buy New York contracts and hedge or sell against Shanghai pricing. Every dollar of spread is free money until the spread closes. That's why today's buying was so violent. It wasn't discretionary. It was compulsory. The machines are forced buyers until equilibrium is restored. And equilibrium has not been restored yet. Even after an 8% day, New York is still underpriced. This is why the rally ignored every technical overbought signal. Arbitrage does not stop because an oscillator flashes red. It stops only when the gap disappears. And now we arrive at the second accelerant, short seller liquidation. Imagine you're a hedge fund that shorted silver last week at $75, convinced the market had topped. You wake up this morning to a $6 gap against you. On a standard futures contract, that's roughly $30,000 per contract instantly. If you're holding 100 contracts, you're down $3 million before breakfast. At that point, the trade is no longer yours. The risk manager takes control. There are no discussions, no opinions, just force buy. The broker hits market orders at 76, 77, 78, regardless of price. They are price inelastic. They must exit. This is panic buying in its purest form. And here's the critical detail. This forced buying is hitting a market with no sellers. That creates a feedback loop. Higher prices trigger more margin calls. More margin calls trigger more buying. More buying pushes price higher. We are witnessing a short squeeze and a gamma squeeze simultaneously. This is why the candle expanded instead of stalling. This is why every dip was immediately bought. The bears weren't debating. They were being executed. Now look at the physical side for confirmation. If this were a fake paper rally, physical premiums would collapse. Dealers would dump inventory. Instead, premiums are holding firm or rising. Why? Because dealers see Shanghai too. They know replacement costs are higher than screen prices. No dealer is going to sell an Eagle at $80 when they know it costs $85 plus to replace globally. So inventory gets pulled. Call for pricing. Out of stock. That's not confidence. That's fear of being unable to restock. This is how you know the move is real. Paper price is chasing physical price, not the other way around. The arbitrage vacuum is still open. The shorts are still being cleared. And until New York meets Shanghai, the pressure remains upward. This wasn't the end of the move. This was the ignition. Up to this point, we focused on silver, the $6 candle, the arbitrage vacuum, the short seller execution. But to understand what kind of event this really is, we have to lift our eyes from the silver chart and look at the signal that matters most. Gold. Silver is volatile. 8% days happen. Gold is not volatile. Gold is the bedrock of the global financial system. A $15 trillion reserve asset held by central banks, sovereign wealth funds, and monetary authorities. It moves slowly. It drifts. It does not jump, except when something breaks. Today, gold is trading at $4,467, up $135 in a single session, a move of over 3%. To put that in perspective, a 3% move in gold is the equivalent of the Dow Jones moving 1,500 points in one day. It is a statistically rare event. Gold does not do this during normal times. It does this during the invasion of Ukraine. It does this during the collapse of Silicon Valley Bank. It does this during the 2008 financial crisis. A move like this is not a trade. It is a distress signal. When gold moves 3% in a day, the message is simple. Capital is fleeing risk, not rotating, escaping. The smartest money on the planet is abandoning bonds, abandoning currencies, abandoning counterparty exposure, and running toward the only asset with no liability attached. Gold is not being bought for profit. It is being bought for survival. And that is what validates everything happening in silver. Silver is not rising because of speculation. It is rising because the entire monetary order is being repriced. Gold is leading the charge. Silver is drafting behind it. This brings us to a crucial concept. Beta. In financial markets, beta measures how aggressively an asset moves relative to another. Silver is historically gold on steroids. Its beta ranges from 2 to 3. When gold moves 1%, silver moves 2 or 3. Today, gold moved 3%. Silver moved 8%. The math is perfect. This is exactly what a healthy precious metals bull market looks like. If silver had moved 8% while gold was flat, that would be a red flag. That would smell like speculation. But gold is leading violently, and silver is responding proportionally. Gold is the engine. Silver is the turbocharger. And here's where it gets even more important: the gold to silver ratio. At the start of the week, the ratio was near 60, with gold at $4,467 and silver near $78.83. The ratio has compressed to roughly 56. That means silver is outperforming, but it is still far from historically expensive. During true bull market manias, this ratio collapses first to 40, then 30, sometimes even lower. In 2011, it briefly touched 30 to 1. At 56, silver is not expensive. It is undervalued relative to gold. If gold went nowhere from here and the ratio merely returned to 30, silver would be trading near $148. That is why the algorithms keep buying. They are executing ratio trades, selling relatively expensive gold and buying relatively cheap silver. As long as gold remains strong, the floor under silver rises mechanically. Gold is the shield. Silver is the sword. So why today? Why did gold explode on a random Tuesday in January? Yes, there's geopolitical tension. Yes, there's noise. But geopolitical headlines usually spike and fade. This didn't fade. It accelerated. That tells us the market is sniffing out financial risk, not just political risk. A problem in the bond market. Stress inside the banking system. A currency devaluation that hasn't been announced yet. When gold moves first, price becomes the headline. Someone knows something. And the market is moving ahead of the news. Now we arrive at the most dangerous phase of any bull market. Not for the system, but for you. Silver is trading at $78.83. For most of the last decade, investors were underwater, exhausted, ridiculed. Today, you're winning. And winning introduces a new enemy: vertigo. When price goes vertical, your brain screams at you to sell. This can't last. This is a bubble. Take the money and run. That instinct is exactly how people get shaken out before the real move begins. Technically, silver is approaching what traders call blue sky. Above $80, there is no price memory. No overhead resistance from years past. No trapped sellers waiting to get their money back. Everyone who owns silver is in profit. When markets enter blue sky, gravity changes. Price moves faster, not slower, because there is no supply overhead. The only resistance left is psychological. Round numbers like $80, $100, $150. Those levels matter not because of sellers, but because of fear. If silver can move $6 in a day below $80, it can move $10 in a day above it. Do not fear the speed. Speed is what happens when a compressed spring is released in a vacuum. The market is not overbought. It is catching up. Now let us talk about the most dangerous trade you can make right now: selling silver for dollars. Ask yourself a simple question: why is silver rising? It isn't rising because it's fashionable. It's rising because the dollar is being repriced downward against real assets. It's rising because debt is unpayable, deficits are terminal, and monetary confidence is cracking. So, if you sell silver, what are you locking in? Dollars. You are trading a safe haven for a liability. You are stepping out of the lifeboat and walking back onto the Titanic because the deck looks calm for the moment. The smart money does not sell into cash during currency stress. They swap. They rotate from one undervalued hard asset into another, and they wait for ratios to signal extremes. That brings us back to the gold to silver ratio. At 56, silver is still cheap relative to gold. Historically, that ratio bottoms near 15 during true manias. Even a move to 30 implies silver doubling from here, without gold moving another inch. The ratio says, hold. Now consider the public. Today's 8% move will hit headlines. It will trend on social media. The average person is only just noticing silver. They haven't bought yet. They're still opening accounts, still driving to coin shops. That means we are not in the mania phase. We are in the institutional accumulation phase. The mania comes later, when your barber gives you silver tips, when Uber drivers talk about ounces, when late money piles in emotionally. You do not sell before the public arrives. You sell to the public. We are not there yet. So, if you feel the urge to sell, recognize it for what it is. Fear of missing out on gains already earned, rather than fear of what comes next. The real risk is not holding. The real risk is exiting early. This is the final chapter of this emergency broadcast. We've broken down the $6 explosion. We've followed the arbitrage vacuum pulling New York toward Shanghai. We've watched gold scream a systemic warning. We've seen industrial buyers panic and physical metal vanish. Now we stand here at $78.83, and the most important question remains, is this the top or the beginning? Here is the verdict. What happened today was not a bubble. It was a correction to reality. For 40 years, the paper price of silver was a distortion, a synthetic number built on leverage, suppression, and surplus that no longer exists. Today, that illusion cracked. The market discovered that silver is scarce, strategic, and irreplaceable. The West lost control of the price when it lost control of the metal. The East now sets the marginal price because that's where the physical demand is. Shanghai is not speculating. It is paying up because it needs the metal. As long as China is willing to pay more, New York must follow. Arbitrage makes that non-negotiable. That is the anchor of this move. Now let's talk targets, not as predictions, but as zones. First is $80. This is not resistance. It's psychology. Once it breaks cleanly, momentum accelerates because there is no chart history above it. Price discovery speeds up when there are no reference points. Next is $100. Again, not because sellers wait there, but because fear does. If the market can move $6 below $80, it can move $10 above it. Volatility expands in blue sky. Beyond that, the gold to silver ratio becomes the compass. At 56, silver is cheap. At 40, it is normal. At 30, it is manic. That is where rotations happen, not before. So what is the strategy? Ignore intraday noise. Ignore red candles. Ignore anyone telling you this has to come down. Watch Shanghai. As long as Asia pays more, the trend is intact. Watch gold. As long as gold holds all-time highs, the system remains under stress. Do not sell for dollars in a currency repricing. If you must act, think in terms of swaps, not exits, and only when the ratios scream excess. They are whispering value right now. The public has not arrived yet. The headlines are just starting. This is still smart money positioning. The emotional phase comes later, and that is where tops are made. Today was the day the truth broke through the screen. The squeeze is not coming. The squeeze is live. Triple digits are no longer speculation. They are the consequence of physics, arbitrage, and scarcity. You are not early anymore, but you are not late either. Stay calm. Stay disciplined. Let the system unwind. This was the $6 candle. The fire is just getting started. Subscribe.